The Little Book That Still Beats the Market by Joel Greenblatt is a popular book on value investing. It introduces the magic formula for picking stocks that are undervalued and have high returns on capital. The book is structured around 14 key lessons that guide readers through the process. Here's a step-by-step summary of these lessons. 1. The basics of investing. Understand the fundamentals of investing, including the difference between stocks and bonds, and the importance of earnings. 2. The value of value. Learn about value investing and why buying companies for less than their intrinsic value is crucial for long-term success. 3. Mr. Market and margin of safety. Meet Mr. Market, a metaphor for the stock market's fluctuations, and grasp the concept of margin of safety, buying with a cushion below intrinsic value to protect against errors. 4. The magic formula. Discover the two main criteria for the magic formula: high earnings yield and high return on capital. 5. Finding earnings yield. Calculate earnings yield by dividing a company's earnings before interest and taxes by its enterprise value. 6. Return on capital. Compute return on capital by dividing EBIT by the sum of net working capital and net fixed assets. 7. Putting it together. Rank companies based on their earnings yield and return on capital, then combine the ranks to find the best investments. 8. The magic formula in action. See how the magic formula is applied in real-world scenarios and understand its historical performance. 9. Buying cheap and good companies. Focus on acquiring stocks that meet the magic formula's criteria, emphasizing both value and quality. 10. Patience and discipline. Recognize the importance of sticking to the strategy over time, despite short-term market fluctuations. 11. The long-term perspective. Understand that the magic formula works best when applied with a long-term view, typically 3 to 5 years or more. 12. Avoiding pitfalls. Learn to avoid common mistakes such as overreacting to market news and chasing short-term performance. 13. The importance of diversification. Spread investments across at least 20 to 30 magic formula stocks to mitigate risk. 14. Review and rebalance. Regularly review and rebalance your portfolio, typically on an annual basis, to maintain alignment with the magic formula criteria. By following these lessons, investors can implement Greenblatt's magic formula to systematically select and manage a portfolio of high-quality, undervalued stocks with the potential for significant long-term returns.